Recording in progress.
Okay, we're good there.
Okay, got it. Okay, let me move these little screens down real quick where I can see them. Okay. Okay, so the goal today is how do we build stress testing models? As I mentioned, in 2010, we had DFAST, which is the Dodd-Frank Act. This mandates that all banks must do stress testing. The entire purpose of this exercise and goal, as many banks think this is kind of a waste of time, but what it really does is it wants to make sure that we have enough capital on hand. So if we have another crisis, whether it's caused by credit defaults, whether it's caused by another mortgage bubble or something, that we all have enough capital on hand that we can float a lot of these defaults. The Federal Reserve picks different sorts of thresholds where you must have enough capital. There's different ways of accounting for this. So, for example, customer deposits are actual dollars sitting in an actual account that the bank has control of. These are considered dollar for dollar. So every dollar that you have in deposits counts as reserves at the bank. But if you have things, for example, like a stock portfolio or a mortgage portfolio, these are discounted back. So you don't get the full dollar value here. So you might only get like half. You might get 50% of the value. So it's more advantageous to hold on to deposits, but at the same time, you're not making any money off the deposits really. So it's kind of the struggle here with stress testing in general. But they're going to have three scenarios that we run and the Federal Reserve actually gives every year. So you build models on data that's provided from like Moody's. Nobody knows what the Fed's going to provide every year. We can kind of predict it, but they're going to give you three scenarios after the fact. So you have to build a model on data you've never seen, and then you have to run these scenarios through your models and hope everything kind of holds up. So that's kind of part of the struggle here. Today, we're going to talk a little bit about Ppnr. This is a fairly big area in banks for modeling. This is pre-provisional net revenue. This basically just means we're modeling the accounting side of this. So anything from assets, liabilities, income, and expenses. But of course, it's a bank, so these things get down to more interesting categories like owned real estate or expenses. For example, I modeled expenses on real estate that were held on books during the default. So in 2008, we had a massive crash. Banks were stuck with massive amounts of mortgage portfolios. They owned all these houses. Somebody has to mow the yard, shovel snow if required by the city, maintain, paint, fix these houses. People gutted them. There's a lot of expenses the banks had to do. And of course, all this has to be modeled for stress testing just to make sure that we have enough capital in case another one of these crises occur. So quickly here are the problems. So we're going to get into actually modeling this here in a second, but the problems we typically face with these sorts of models, specifically with time series, is going to be stationarity, white noise in the residuals, which is an issue with serial correlation and randomness or normality. The banks also like to have two or more exogenous variables. So any external variable like GDP, CPI, unemployment, those sorts of things. We don't like to be solely dependent on one variable, but you'll see here it's really challenging sometimes to kind of fit in variables, even though you think they should drive it. Often one variable will push out another variable because macroeconomic variables are so highly correlated that often it's hard to get two or more of these to go into a model. And finally here, the piece that's the hardest is going to be reasonable forecast based on the business here. So even as a statistician or a quant and you build out models and they're amazing and they work well, if the business decides that the shape of the curves don't look what they expect, often you're kind of fighting this, does the business really know what they're talking about? Or yes, the business definitely knows and the model's not performing as expected. So again, height and duration of these kind of stress scenarios is a piece of argument here against the Fed, for the Fed, depending how you look at it. But these sorts of shapes and timing are going to be crucial for actual forecasts at the end of this. So that's kind of another issue we face. Solutions wise though, simple code. So we're going to use Sas today. I'm just going to go through a few pieces of code and chat about those a little bit because Sas, I know it's vastly unpopular with everyone these days, with open source being the fun and exciting tool, but Sas actually handles time series extremely well. Very, very small nuanced pieces inside of this little piece of code. So at the bottom here, this is kind of an example of code, and I'll go through what the pieces mean towards the middle of this presentation. But little tiny, yeah.
Sas is software as a service, right? So like languages and coding, like programs you have to pay for, right?
Yeah. SAS cost money. SAS is a very, very expensive software that's used by almost all the banks. So it's just not necessarily SAS. I guess different ways to think about this. SAS is a actual product provided by a corporation in itself. So, but it's very expensive, and so banks hate using it. It's rarely taught in universities unless you go to like UNC or the University of North Carolina or NC State, North Carolina State, because the SAS corporation that actually builds SAS software, so SAS being SAS, they're located in this area. So it's the predominant software most banks use. But we're going to try to handle things such as differencing shifts, serial correlation through autoregressive and moving average terms, as well as seasonal AR and MA terms. Now, you guys can do this in Python. You can do this in R. A lot of the packages, though, don't support, for example, multiple exogenous variables, or the augmented Dickey-Fuller tests aren't implemented quite correctly. This creates a little bit of an issue here, but it depends on which package you're using. So that's kind of a little caveat or something to keep in mind. But we're going to address stationarity, serial correlation, significant variables, and white noise here in this presentation. And just to give you guys kind of a quick forecast example, this is what we kind of get at the end piece here. This is what the business is looking for. This is what regulators are looking for. You're going to end up with charts. So on the left-hand side, you can see this is for KeyBank. On the right-hand side, this is for First Mortgage. NCOs or net charge-offs, if you're curious what that is. You can see on the right-hand side, for example, in 2007, between there and about 2013, there's this massive net charge-off on the actuals, meaning tons and tons of customers defaulted on their mortgages. And of course, you know, they lost, looks like around $100 or $1,000 million here, so $1 billion. So you're losing $1 billion basically month over month or year over year, month over month, depending on how this data is put together. But the goal of this is we're trying to get these nice curves that we're looking at. So the green is the actual data. The orange, for some reason in these charts, is the baseline. This is what we expect with no economic crisis, no issues. And then the blue is going to be like an adverse scenario. Things are kind of sketchy. A few things went south, but not too much. And then the yellow lines are going to be severely adverse. And this is typically modeled after past crises. Like we're expecting something big to happen here. Like it's going to really crash here. So right now, I think in the scenarios, for example, inflation's already baked into a lot of these stress tests. These would be severely adverse. But another piece here too is the rank ordering, which I kind of have on the bottom. In both of these charts, you see that the base is the lowest. Then you have adverse, and then you have severely adverse because these are going to be losses. Anything that's an asset will typically have a flip. So your base will be the highest. Things will be great and wonderful. And then as adverse and severely adverse scenarios hit, we would expect that the charts would actually be lower. So when you model these, it's kind of odd because sometimes you'll see these actually cross and weave, which we don't like. And other times they might have an odd order where you have like the base at the top, then you have severely adverse, and then for some reason adverse does the worst. It depends on your data, it depends on your model structure, but these are kind of pieces and issues we struggle with on the modeling side of the bank. So this seems super easy, right? We're going to get some data, we're going to fit it, we're going to use like an ARIMA model or a GARCH model or something, and then we're going to generate some really pretty charts here like in Excel like this, and that's kind of the exercise. And it seems really simple, but unfortunately, there's going to be a lot of kind of issues with doing this, and things don't technically work the way you expect them to work. So theory-wise, just to kind of lay some foundation here, an average model at a bank takes around 3 months to build with a team of 1 to 2 people. Sometimes there's 3 or 4, depending on how many layers of management are involved. You need a deep understanding of the business problem itself. So often we're modeling expenses or assets or income or different things. We need to understand the product line. As an example of this, I modeled mortgages, and somebody put in there a 3-month interest rate, and it was a portfolio. So I went and talked to the business here. The average duration of this portfolio is 20 years. So using a 3-month rate seems kind of weird. Like, why would it be so sensitive to 3-month rates? We rebuilt models out to have, I think, like a 10-year or a 30-year because we didn't have a 20-year at the time. But again, trying to match those variables based on your business problem, understanding those people is kind of an important piece of this as well. And of course, everything that bakes into this is going to be measure theory, probability, statistics, and time series. because this is all kind of a time series and stochastic processes modeling kind of exercise here. Issues wise though, data is often not stationary. So you'll learn in school, you take a quick first difference, and we'll kind of cover this here in a little bit. But sometimes that doesn't even work. And sometimes the variables that you think should drive the model, we can't find stationary transformations of. And this causes a lot of headaches with development teams, business units, everybody across the board. There's really not an easy way to do this. And banks will often create a massive number of transformations, which we'll kind of show here in a little bit. But anyways, you can grow from say like 100 variables up to like 900 variables just on transforming those 100 variables based on different types of transformations we expect. Sometimes when you transform them, we can get really nice behaving stationary variables, but often we're spending weeks sometimes playing with the amount of variables we have, trying to figure out which ones are going to work, why they don't work, and how we might be able to kind of fudge them or fix them. Time series issues manifest themselves though in many, many ways, and they're kind of hard to track sometimes. I have a paper on diagnosing kind of this problem. It's called Uses and Abuses of ARIMA Modeling in Banking. I have it, my paper in 2016. But again, it kind of goes through a lot of these issues and struggles and shows basically ways people misread these charts. So anyways, that's kind of just the foundation here. Let's actually build out a model here. Just for hypothetical reasons, we'll say we're going to work on an expense account. But when you get data typically for these sorts of modeling here, everybody talks about in the industry that you have like data processing and cleaning.
We're good. We're good. I just wanted to, any questions, anyone? No? Okay, we're good.
Okay. So typically we think a lot about, data cleaning and processing. We hear a lot about this on the data science side. Oddly enough, though, for modeling, for CCAR purposes, you typically get nice, clean data that doesn't have a lot of these issues here. So this is kind of a nice, fun area to work in a lot of times because you're not wasting so much time tinkering with the data and kind of trying to figure out how to fix it and clean it. So missing values typically are never the case. We just check, though, for best practice to make sure everything's coming in correctly. I will note, too, you spend millions of dollars on data, for example, from companies like Moody's. And often the data they provide you, even though it costs you a lot of money, is not correct. So we do data quality checks, typically from a different department, just to make sure the data is coming in correctly. The other piece, though, is you need to figure out the granularity of the model you're doing here. So for CCAR stress testing, we have to do a 9-quarter forecast here. You can, if you do monthly, it's got to be 27 months. Quarterly, it's 9 quarters. Often it's far better and easier to model monthly data because you have more data points. The trends and patterns will be a little bit clearer, but sometimes we just don't have that data. So if the bank does not collect, say, expense data on a monthly level, then you're only going to get stuck with quarterly data. And that causes a lot of issues, but sometimes that's just the problem you're kind of stuck with. Splitting your data, though, make sure you split this into development and out of time. And this data, we're going to hypothetically split. Yeah, go ahead. Question?
I do have a question, please, if you don't mind.
Yeah.
Can you hear me? Can you hear me?
Yeah, I can hear you.
Okay, so you were talking about the granularities of the data, right? And I follow a case study about the climate risk and its impact on mortgage portfolio. And I've done some literature review, and in general, it is said that like the current methods on measuring the climate risk, the data is not granular enough. So I kind of want to ask you, like, how granular is considered, like, enough to.
Okay.
Yeah.
Yeah. That's a great question. It depends on the problem here. So I'll cover this from 2 perspectives. For stress testing purposes, we typically just use monthly. And it's really, really high level if you think about this, because imagine you have, I don't know, 100,000 in mortgages, but we only care about, for example, the balance of that account or the expenses associated with that account across time. So that's very, very high level. Now, if you're going to model something, for example, like expected loss on a mortgage portfolio, you would use something like probability of default, loss given default, and exposure at default. So the typical credit modeling equation. When we do this though, we have data all the way down to the individual account level. So I'll have every single mortgage. I will have information on their FICO score, the person that owns the mortgage. I will have how many defaults they've had in the last 60 days, 90 days, how many charge-offs they've had. I will know their address. I will know, like, basically we have as much information as possible that we get on these customers, and it will narrow down exactly to the mortgage level.
And also when I follow the case, I noticed the problem is that, the changes in climate factors and even the transition to the net zero economies, sometimes like the granularities, the granularity of data about mortgage portfolio and about the climate factors, they kind of does not match. So is it like, do you think it's like a major challenge if we want to do stress testing or the scenario analysis? And, because, the ununiform of granularities of data.
Yeah, so that's actually an excellent question. So we have to do, per regulations, 2 types of modeling. We do this, which is stress testing for CCAR, and then we do CECL, which is the current expected credit loss. They will typically use separate models for the exact same portfolio, just because you have kind of 2 separate goals, which you're kind of pointing at. It's so hard to model macroeconomic data because the data is so high level. We have like a monthly value for GDP, and everybody gets applied across the board the same GDP value. So you'll end up having 2 models. You have one that does macroeconomic forecasting for capital levels, and then for actual daily business usages, for example, how much do we price for interest for that mortgage? Which customers do we originate mortgages to? All of these will be done on a separate model that actually ignore the time series component. So I know this seems kind of odd, but typically the reason they do this is because the amount of volume of mortgages that go through a bank often is so large that they're not too concerned. And there are ways around this. You can use panel models, for example, if you're trying to incorporate time series, which some banks do. There's also a super fancy method called dual time dynamics, which uses stochastic calculus and stochastic processes to actually model out maturity curves of these mortgages and then tries to bake in on top of that macroeconomic effects.
Okay, that's all the questions I have. Thank you.
Okay, yeah. Okay, so for data-wise, we're going to split this data into development and out of time. I say this as if this is like common sense, and yet in the industry, I've seen people attempt to basically blend all of their data based on time and then randomly sample from it as if it's a cross-sectional data set. You cannot do this. This violates so many statistical assumptions and makes your modeling infeasible. But I'll note here that for the development data, we typically like to select a crises year. So if I can get data back to 2005 to 2000, I want that data because I want to see what a good solid market is like before the crisis. I want to see the crisis inside of that data set. And then I want to see how the market settles after the crisis here. So 2005 to 2020 in this example would be a great time frame because we should be able to capture a lot of those kind of dynamics. Our out of time are typically quite short. Again, it's this trade-off of trying to think about if you have too much data in the out of time, you might not capture kind of more modern trends that the model's missing. If you don't have enough data in out of time, then your model might seem robust when it's really not. So typically a year's common, 2 years is okay, but anything more or less than that typically falls just in kind of a danger zone of you're risking either not having enough data or you have too much data and you kind of get mixed results with your model robustness testing. Your data will look like this, though. It'll look nice and pretty. Typically, you'll have a column with all of the dates. So on the left-hand side, we have, for example, all like your development. It'll go from 2005 in January all the way to December in 2020. Again, this example is just monthly. And then you'll have your validation sample look the exact same, except for it'll go from 2021 to the end of 2021. Again, 12 data points. Your EXP here, so that second column is just going to be our dependent variable we're modeling here. And then all the independent variables. So you could have, again, anywhere from, I don't know, 30, 40 variables out to like 1,200 variables, depending on the problem, depending on how much data we actually have. But this is kind of the structure you'll see, whether you're using R, Sas, Python, anything like that. It will look basically like this nice, pretty kind of format. So there's not a lot of manipulation you have to do on this end. And then for methodology here, I'll emphasize this enough because I get at this as a kind of a common question in the industry. The data itself is going to actually predict the problem here. So the data is going to tell you what type of model to use. You don't tell it what model to use. Now, after you've done this quite a bit and you model the same portfolios over and over again, you really understand, like I already know what type of model we're going to have to use just because I know the data so well. But when you get new data or you start a new job at a new bank, you need to go through this process of looking at the data, the features, the problem you're trying to model, and then really picking the model based on the data itself. So I can't emphasize that enough because I still see this as an issue in the industry for some reason. But common methods are going to be OLS, Cerimax models, which include all the ARIMA structures of autoregressive, moving averages, ARMAs, ARIMAs, all that. GARCH models are common if you have varying volatility in the residuals here, which is not super common, but it can be used depending on the problem. And then if you want to go into the machine learning realm here, we want to think about Lstm models, which is really a time series based approach with neural networks. You might deviate into other kind of realms too, but these are kind of the big ones. So just to go through this quickly here. So now when you have your data, you always start with the simplest method first. If we can use OLS, let's use OLS. Let's not overcomplicate this. But the issue with OLS is that your residuals have to be IID. The data itself has to be IID. When you have serial correlation in time series, which is almost all financial data, you can't use OLS. For some financial problems in banks, if the data sets are large enough, for example, in credit modeling, we use logistic regression. We ignore the time series component because the amount of volume of loans coming through, and if products are short enough, so if you think about like auto might be between 2 years and 7 years, typically we can rotate enough loans or we can package them and sell them to other banks fast enough that the time component isn't as big of an issue as it would be with like a CCAR stress testing model here. So OLS just doesn't work often because we have time dependency, which is manifested through serial correlation testing. LSTMs can be interesting. They can work well, but regulators don't like the fact that they're neural networks and they can be challenging to explain. So we kind of put that on the side for now. Again, Cerimax models and GARCH models are feasible, good solutions for solving these problems. Again, we have to test though for heteroscedasticity. So if those residuals have, changing variance, then we'll use a GARCH model. But most of the time you can build it and not have that issue. So we'll start here at the Cerimax model structure just because we know that's kind of where we're going to end up heading. But you should test this in practice. You should test your data, like your OLS data, to see if you have serial correlation. And then, as I mentioned before, variable preparation. You're going to have month-over-month growth rates, quarter-over-quarter growth rates, year-over-year growth rates. You can do lags. You can do differences. You can do double differences. You can do seasonal differencing, which I haven't covered here. So I don't know why, most programs don't teach this. If you're looking for stationarity in a variable, you can take a first difference and a second difference. But often, seasonal differencing is kind of the secret for getting something to be stationary that's not.
Hi, Dimitri. Real quick, this is actually pretty cool because everything you're talking about, obviously stochastic calculus, AR, MA, ARIMA, ARMA, like we all have classes on that. You go back a slide real quick and talk about Cerimax, we don't go over, and then I think LSTM, you don't cover that either.
Okay, yeah, I can talk about that. So LSTM, just quickly, is long short-term memory models. If you know what an ARMA model is or an ARIMA model, it's exactly that, but it's done with neural networks. And there's going to be neurons that are short-term memory and long-term memory. And all that really means is if you think about like an AR term, is it an AR1 term? That's probably a short-term memory. If it's like an AR12 term, that's going to be a long-term memory. So it's just a fancy way of using neural networks to try to model basically ARIMA. It's a way to do it. Cerimax, I'll talk a little bit about. We'll go through some of the specifications for this. I view all time series structuring here as an ARIMA of some sorts. The X on the end just means exogenous. So you need to include something like GDP, unemployment, something external to the model itself. Whereas when you typically do ARIMA, right, you just have like lags of the dependent variable, which is the endogenous component. And then the S at the beginning of this is going to be the seasonal component. And I'll talk a little bit about this. You can do seasonality things, for example, seasonal differencing. So instead of, first differencing is Y of t minus Y of t minus 1. So today minus yesterday, that's your first difference. In financial data, you typically have trends. So think about, think of a good example. Think about like the auto market, for example, right? Everybody gets a refund, or most people get a refund towards the spring. So a lot of people buy new cars or pay off their cars. And then as the summer comes, people kind of fall behind. They kind of struggle. They want to use their money to go on vacations. So they miss a lot of payments. You have high default in the summers. And then when Christmas comes around again and the holidays, people start buying cars as gifts. You'll have a seasonal component here. And often with this data, if you do a first difference or a second difference, it won't become stationary because the gap between the data points is too big. There's a seasonal component. So instead, what you can do is you can do like, say I know that there's a 6-month lag between, I don't know, Christmas and tax refunds, for example, and it happens every year. So it's the same pattern. What you can do instead is do Y of t minus Y of t minus 6. So it's a 6-month lagged difference. And often this will actually get you stationary passing of tests, basically, that you couldn't see or couldn't find without using that. So that's kind of one piece. The other piece is thinking about if you've done ARIMA models. I don't like the way they teach it and the fact that when you think of like an AR3 term, they assume that you have basically 3 components. You have an AR, lag of 1, lag of 2, lag of 3, and you add all those into the model. Often that's not realistic, right? You might have a 3-month lag or a 6-month lag or a 12-month lag of some seasonal component here. So instead, what you do is instead of adding all of the AR terms in the middle, so 1, 2, and 3, you would just add the third one. So you would have your beta coefficient, and then you would have Y of t minus 3. And I'll cover how you do this in SAS in a little bit when we start doing lags and shifts. But these little nuanced details make a big difference when you actually fit the model and finding ones that work.
Cool. Very cool. And for those of you wondering, that's Dr. Wu's financial forecasting and simulations class. I think some of you are at it, right? Cool. Thank you, Dimitri.
Yeah, no problem. And then on the variable preparation, we talked about lags, shifts, month over month, quarter over quarter, year over year, growth rates, differences. These can all be baked in a transformation step in your data preparation. I will note, do not take growth rates of growth rates because banks don't like this because it makes no sense. Regulators don't like this, and they'll often fail your models. But when you think about this conceptually, like what is the growth rate of like a interest rate? It's hard to really conceptualize, and business users at the banks will try to justify it. And I've even seen a growth rate of a growth rate of a growth rate. It's like double growth rate. You start thinking physics, I'm thinking like velocity and acceleration. I have no idea how you, transform that into business speak of what is like the acceleration rate of an interest rate. It doesn't make sense. They're really hard to interpret business-wise and how they impact the model. So in general, most banks have rules of do not use growth rates of growth rates, even though sometimes they have really good correlation and they fit the model well. So now you've kind of got your data prepped, right? We've done all the transformations. We've got this big data set sitting there. Next, we need to go through and start doing your augmented Dickey-Fuller testing for stationarity. Again, you always do everything in the model has to be stationary. The dependent, the independents, and your residuals here. So it makes most sense you start off coding through and testing out your dependent variable Y. This is some Sas code just to give you guys kind of a little bit of an understanding of how this works when we code this out. There's an identification step, which is that second line. And you just type in stationarity and do ADF, and we set it equal to 12 for stress testing. So you need a full business cycle here, right? You don't want to test stationarity for one lag because it's not really capturing that whole seasonal cycle that we're probably going to miss here. We're seeing something in the data here. So you should do one full cycle. So imagine doing like a trading application If you're trading, you have daily data. You'd want to check at minimum a 7-day period. So you have a weekly, or I guess 5 days, you have 5 trading days. But you want to check kind of a weekly cycle. You might even want to check out to like a full monthly cycle and do, 20 days on a trading month, give or take. But you want to go through and you want to test all these different variables in here. So when we have to write the code for this, you can automate this and create loops to do it. But you can feed in your data, do your differencing. Again, in this example, we just use y of 1. The 1 in the parentheses in the code here just tells it to difference it once, and then test that for 12 lags. And we'd want to put every single variable that we're considering using into this model. Typically, I use correlograms, where you can use massive correlation tables, and you can do if statements, and you try to pick some sort of threshold to weed out your variables so that you narrow it down. Because if you have 900 variables or 1,000 variables, it's nearly impossible to test every single combination of every variable in these models. And so it makes a lot of sense to use correlograms and just kind of focus on the high correlation ones up front. And I'll explain here in a second how I use a method for picking up minor details. But you're going to use this basically to narrow down and check all your stationarity of the variables that you think are going to be the most important. If you want to add more variables later, definitely test the stationarity before you add them into the models. This is output, what it would look like in Sas. This is why I like Sas so much, just because the tests and the tables are so nice and clean. The table on the left is what you should see. You should have zero mean, single mean, and trend. There are 3 types of stationarity tests that you can actually use here. Zero mean means that it bounces around the 0 line. So if you guys have done, stochastic calculus, a white noise random walk bounces around 0. That's zero mean. Single mean means that it's going to bounce around 1 level. So maybe the single mean is a value of 10. You should expect to see that line kind of bouncing around 10. And then trend is going to be one that has stationarity, but it has some sort of linear trend that's going up across time. The charts on the right here, would be considered zero mean because you can see the data points on those charts is bouncing around that 0 mark here. This is a difference series. Anytime you difference data in itself, it should be zero mean. Just by definition, mathematically, when you take a difference, you'll end up with zero mean. One of the common issues and mistakes we see with reading these tables. So again, this table on the left only has 2 lags. We would hypothetically run out to 12 lags typically with the ADF test, as I mentioned. Is learning to read the row column. So this is kind of an odd thing, but you check the p-values for row when row is going to be less than or equal to 1. When row, though, is greater than 1, you should be using the tau test. This is like the biggest issue we see in the industry for some reason. You can find it in the original Dickey-Fuller paper. You can find it in the paper I wrote as well. But reading these tests is really, really important because sometimes you'll pass stationarity for lags like 1 to 8, and then all of a sudden you look and 9, 10, 11, 12 seem to fail, but it's because your row test is no longer valid and you have to shift over and use the tau test. On the right-hand side, though, these little charts that are kind of generated here, this just gives you a little bit of an indication of what you're dealing with, what test you should be using. If it's zero mean, single mean, or trend, and you can use this to kind of help diagnose which test to be using for the ADF. And then the next step after we've tested the stationarity is going to be using cross correlations. And I've seen a lot of issues with this for some reason, but it's a tiny step that just gets missed. Often 2 variables can be correlated with each other, but sometimes it's the lag of that variable that has a higher correlation than the variable itself. Inside of Sas here in the code and the identify step, we just type in cross core, which does the cross correlation calculations here. In this example, I'm looking at, I want to know all the cross correlations between the dependent variable and these independent variables. And so we're going to use GDP, the Dow Jones Industrial Index, LBR, which is unemployment, and I3M, which is the interest rate for 3 months. So we would check the correlations between each one of these variables and the dependent variable to see where the lags are going to fall and if we need to shift any of them. Again, you need to make sure these are stationary. In Sas, you can actually do the stationarity with just a simple parentheses with a 1. So for example, in this case, for the Dow Jones Industrial Average, I can just quickly add in parentheses 1 and then close it. And that will give me the difference variable. And I don't have to manually go in and create second or third versions of all these variables. The $ is going to be a shift operator. So again, that's going to lag the variable. So if I need to lag it 1 time, 2 times, 3 times, adding the $ will allow us to shift that variable. And you can actually add a number after it. It will define how many lags you shift. This is kind of the analysis you get out of it. So these examples aren't stellar here, but you can see, for example, let's see. The cross correlation here for the first chart is going to be for the triple B. The highest bar, the highest correlation is going to be at 0. There's no reason to do a shift here. The chart on the right has the exact same thing. There's no reason to do a shift. Now, you might think about this from a business logic standpoint. And for example, the chart on the left, you see that there's a bar that's higher, but it looks to be out. Let's see. It looks to be right about like 12 lags. So we actually might think about this and say, okay, a 12 months ago, the triple B is going to be predicting whatever we're modeling here. So if we're modeling expenses, we might lag that by 12 months. And so what we would do is go back into the code here, have the $, add 12, and it would lag this and it will reprint the correlation charts. And you can see if we're maximizing correlations for this. In practice, there are typically 1 or 2 variables where you have like a 1 or 2 lag. And even, for example, one of the models I worked on in the auto industry was a lag of 1 month. And it had to do with the way the data was processed. So once the loan was booked, it took 12 months for that data to get processed, originated, finalized, and into our data system. And so that was actually a business operation lag. So it made sense that we would add that lag into the model from a business standpoint here. So again, just because you see a correlation here, just because it maximizes, try to think through like, okay, is it a 12-month lag? Is it divisible by something? Is there a seasonal component? Why would the business agree with this? Or what could be causing this? And trying to look for those causations behind the scenes. And this is how you can kind of diagnose what's going into the model and make sure you have the correct lag structure set up for this. And then finally, now that we've kind of picked out in the identify step here of our code, we've picked out our dependent variable in the var statement. The cross correlation set defines all the independent variables or exogenous variables we're going to be using here. It sets up the differencing for us. It sets up the lags for us that we've already identified. And then finally, we're going to do the fitting of the autoregressive and the moving average components here. So when we fit this originally, you can fit it with no P's and no Q's, so no AR, no MA terms, and look at the residuals. And you'll have charts like this where you see blue lines, which indicate the significant zone. So anything inside of those blue zones, we don't need to address. Anything that falls outside of that, we do need to address. We need to add some sort of MA or AR term to do that. I'll note too that AR and MA terms typically cancel each other out. So it is best practice to start with the simplest model. So if you want to build something, try building a pure AR model and just using p-values. And then if that doesn't work, try doing a pure, MA model with just the Qs, and you can add different values for Q here. SAS allows you to do a variety of things that with P and Q. As I mentioned, if you would have had in this statement P equals 3, you would have 3 AR components. You'd have AR1, AR2, and AR3. And if you put them in parentheses here, as I'm noting, we're going to get that lagged seasonal component I talked about here. So for example, in this, it says estimate and it has P equals 3. That's really going to be Y T minus 3. So we're having a 3-month seasonal lag. We're skipping all of the components in the middle because they don't add value to the model here. You'll see when you fit for CCAR, you often can never get p-values, so hypothesis testing for your coefficients. The coefficients on the AR and MA terms actually won't be meaningful. So it makes no sense to add them in the middle often. And another kind of advantage with R here, or with SAS here, is you can add multiple values here. So we could have a P3 seasonal component. We could have a P12 or a P9 or a P4 or something different on top of that. So you can actually stack these models out and have multiple Ps and multiple Qs. But again, the challenging part of this is that if you guys have worked with ARIMA a little bit in class, the more things you add into the model, it pushes out other pieces of it. So you might have a great model with P3, and there's a little bit of an issue at a lag 4, so you add Q equal 4. And then as you do that, it creates basically now the P's are insignificant, or maybe, GDP was an exogenous variable you used, and now GDP is insignificant. So these time series things are challenging because as you try to fix one problem, often other problems kind of come up here. Yeah. So I'll talk a little bit about the variable fitting. I mentioned it before. One way to do this, as I talked about, we narrow down the variables based on business logic, based on high correlations, and you'll fit some sort of model. And let's say we fit this model with just GDP. And now I need to add one more variable into that model. One way to do this, which I've been doing this since I started my career in 2014, it's essentially like gradient boosting. So think about gradient boosting for decision trees. What we're going to do is we're going to print out the residuals of this, and we're going to run a correlogram or correlation table for the residuals against all the variables. So I know that GDP is in the model, and then whatever that remaining pieces I'm trying to get, I want to fit those residuals, that pattern that I'm missing in the model here. You can look for the correlation between the residuals themselves and the other variables, and often you'll find a second variable that will fit. And that variable typically has a very, very minor correlation to the dependent variable. So you would hardly ever think to use that variable. You typically would never pick that variable up in your initial state of using the correlation tables. But once you fit your model, you can use those residuals kind of as a guide to pick those minor variables that you might end up adding in to pick up those little trends and patterns that we're not quite picking up in the residuals themselves. And then after you run your whole model here, you should get residual chart analysis like this. We should see 0 correlations. So ACF and PACF should all be in the blue lines. This is an example of, we probably have an issue here on the chart on the PACF on the right. There's a bar sticking out. It looks like around maybe 13 lags. And that might be an issue. And then more importantly, we want to look at the bottom right-hand table, which is the white noise test. White noise just indicates we have no serial correlation in the residuals. So there's nothing, no trend time piece that we're missing here. And then you also want to make sure that your residuals are normally distributed, which is what this white noise test does inside of SAS, in the sense that we're still have normality. And I don't have the charts here, but normally you look also at the residuals plotted out with a normal distribution curve to see how close to normal we are. And you can do statistical testing for that as well. I believe the Brush-Pagan test for that. But once you have normality in the residuals and you have no serial correlation, you've basically removed everything down to white noise. Everything that's left is just kind of pure randomness. So that means you've reached the final stage. Your model's working, at least on a statistical level. And then on structure here, the things that we're looking at, the things that we care about, again, are all the p-values for all the model components less than 0.05. As you'll see in practice, this is extremely challenging because as you add in AR and MA terms, as you add in exogenous variables, you fix one piece, but then you create an issue with something else. So now something that was like your AR1 term might be extremely significant. And then as you add in an exogenous variable, now it's not significant. And so developers get this frustrating piece where you spend weeks, sometimes months, adding things in, taking things out, trying just to get some sort of structure with 2 exogenous variables, plus getting your residuals to white noise. And this whole kind of process, there's no real easy way to do it. So you kind of have to trial and error. And the more you do this, the more you understand the business side of things, you'll understand like, okay, this interest rate is not the highest correlated, but it is correlated quite well. I know this is going to work because I've worked at the business for so many years. I know it's what's driving the business. And often these business insights can make the modeling process quicker. So again, being a quant, being a nerd and knowing the stats and math is great, but knowing the business side can save you a lot of time as well. The other thing we look at is the coefficients, directions. So is the coefficient negative or positive? Is that the right direction based on the business relationship? So do we expect it to be moving in that direction? Business logic for exogenous and endogenous variables. I can't stress this one enough. Often the business focuses a lot on the exogenous variables. So GDP, unemployment, interest rates, defaults in the last 90 days or something. And they're looking at this, trying to logically build these out, but they often don't stop to think, maybe I have a lag of 7 for my AR term. But the question is, why does 7 make any sense? On a 12-month, 12 months in a year here, on monthly data, it makes no sense to have a 7. And often if you switch that to something close, like maybe 6, maybe there's a semi-annual pattern there that we're missing, it might not be as significant, but if it's still significant and it's still driving the model, it's usually better to pick things that make business logic and sense. And you can kind of build a story around why the model works, how the model works, and why things have the shifts and the lags they do. And then finally here, right, testing those residuals. If you have no serial correlation, they're normally distributed. They will also be stationary. We also test this though, just as a safety precaution. And now that we've got this model fit, it passes the business logic, everything's set up for us and we're happy. We still have one more hurdle to clear, and that's going to be the forecast here. So we have to run now the 3 forecasts we talked about, the base, the adverse, the severely adverse. And we need to make sure they're in the right ranking order, as we mentioned. So if it's expected base will be the lowest, I want to see base is the lowest, then I want to see adverse, then severely adverse. And typically this will go through the business review process. So you build the model, you think you've got it all dialed in, and then you present it to the business that will be using this or that actually does the daily business. And they will tell you if they like things or not. Sometimes you have very frustrating reviews on these because we look at things, for example, like duration. So how long does it take to go from the starting point back to the original point here? So in this example, if you look at the severely adverse curve, we go from about, I think it's about 17 months, and we go out to about 22. So if you think about that, okay, 17 to 22, we have about 5 months. Does it make sense that we would hit the crisis, we would have some massive losses, and within 5 months, we'd all come back down to normal? Probably not. So this might not be a very realistic chart here. But then you have to dig deeper and think, okay, the variables that we were given or were using from Moody's, did they have these scenarios baked in to have a 5-month span? Or maybe this is 5 quarters, for example, trying to figure this out. You have to start thinking through those sorts of things. The other thing businesses don't like is how high the spikes go. So if severely adverse goes too high, then we have to hold more capital on book. And banks don't like to set aside a bunch of extra capital just sitting there not doing anything, right? I can't loan it out to other customers. We can't purchase other assets. I have money that's not working for me anymore because it's just sitting there in reserves. So thinking about how high these are, does it make sense that these are that high? Sometimes you might actually go in and build out past scenarios. So I might think, okay, my data doesn't include the financial crisis in 2007, 2008. Maybe I go back to even like the tech bubble. I try to pull that data, and then I try to say, okay, we have it was a 10%, 20% loss within 3 months. Let's build out some synthetic data here, some sort of forecast on our own. Let's see if the model is sensitive enough to capture these. Because I want to make sure it's sensitive enough that's actually working. That like if the market crashes tomorrow and GDP tanks, if my model is still predicting that everything's fine and well, the model is not working. We still need to make sure that that causality is there and the model is sensitive enough to those drivers being the exogenous variables that we're using. So that's kind of my rundown. That's my presentation on how we do CCAR stress testing. Again, it takes like months to do these. It takes teams. It's nice to bring in the business side too, to kind of get questions from them and expertise on what they know. They give us little tips and tricks.
Very cool. Question? Cool.
Hi, Dimitri. I'm Ren,
Hey.
and I have a quick question. So you just said that once you develop the model, it's better to go back to some historical significant event to test some shock to test if your model works. So my question is, when you test that, and let's assume your model already incorporated, let's say you use training data that already has those past event incorporated. So would that be meaningless if the model is already learning that and you use that to predict those events? You know what I'm saying? I'm not sure if I.
Yeah, no, I understand it. Yeah. So in your example, you're absolutely correct. Let's see, if our data is already including the 2007, 2008 financial crisis, we wouldn't want to use that as a stress scenario. So we might end up saying there's simple things to do this. You can go back to like tech bubbles or other crises that we missed. So you hardly ever go back to like the early 2000s, but it's occasionally happens. The other part of sensitivity testing we can do is what happens if we stress each individual variable by a specific percentage. So let's say, I don't know, unemployment spikes by 25%, which is a huge margin. And then we'll rerun the model here and see how sensitive the output of that model is based on just the one variable moving by 25%. So you have to get a little creative sometimes. Banks do it a little differently here and there, but stressing each individual variable is one method. Again, right, you would never want to use a scenario that's already in the data because you're right. You would definitely like be modeling the same thing that's already present.
So what you mean is just try to reproduce the past scenario in the present data, and you try to stretch, like let's say like improvement, there's a spike in unemployment, you just kind of tune the unemployment rate to a scenario and see how the output would be. That's what you're saying.
Yeah, exactly.
I see. All right.
Yeah.
Hi, Dimitri. Thank you for bringing that. It's really interesting. I have a quick question, I guess, about like business politics and how this works. So when you're making models, how often do you see like banks or whatever will say, okay, yeah, that makes sense, or they more often say like, hey, can you try and run it so we get this result?
Yeah, so that is an excellent question. This is half the battle we fight, because often we will generate something like these forecasts, and then the business will say, well, these seem a little too steep. And so they do what they call, sometimes they make you rebuild the model, which is why it can take 3 months. Because now you've built a model, it's amazing, it's taken you, let's say, a month to build it. And then the business will say, we don't like the forecast, redo it, but I want the line to be closer to something else. So this is a definite struggle here. The other frustrating piece is even when you build a model, sometimes they will do what they call a model overlay. And a model overlay is basically just like your results are good, but they're not severe enough, for example. And so then they'll add on another curve that's like, say, an extra, I don't know, $1 million in losses on top of that, for example. And combating this is very, very challenging because the business is making the money for you. So they, in their opinion, feel like they know it far better than everybody else, and you know nothing because you're just a quant. And trying to build those relationships is important. One way, as I've kind of mentioned, I'd combat this is, as a developer, it's helpful to meet with the business throughout the development process. So one way I do this is I build out those corelograms we talked about. I pick the top 10 variables I think are going to be the best, but then I take the full list of variables. I don't give them any correlation information. And I say, hey, can you guys just highlight on this sheet like the top 5 or 10 variables you would expect to drive your portfolio? And then I take that back into the development process and try to get a little bit of buy-in from them. If they feel like they help build the model and they understand the model, they're more likely to accept the results versus just like building a model and then showing them the results, because often it shocks the business, the actual outcome. So there's no real easy way to deal with the business, but yeah, it does happen. And there's a lot of politics and kind of battling between the quants building the models and the people who actually use them at the end.
Cool, thank you.
Yeah.
Very cool. Kind of piggybacking off of that point, Dimitri, it sounds like you need just as much like qualitative skills as you need quantitative skills to be a good quant. Would that be a right assumption?
Yeah. I think this is kind of my frustration with the industry as a whole, which I'll touch on. As you guys know, right, you're going to school, you're taking all these math and stats classes, you're taking finance classes. It's really hard to learn all the information you need to do the job. So often we focus so much on the quant side. We want to be the best quants out there. We want to make really good models. But there's also, as you're pointing out, and we're talking about here, right, the qualitative side is the really other hard piece you have to kind of build at the same time. So understanding the business is part of it. Learning to get buy-in from people. So trying to convince people and train them and educate them. And then just communication and even conflict management. So I'll tell you guys a story here. I've had a model and I worked with someone on, And as tensions escalated in this meeting, as people were kind of arguing and fighting over, are we going to use the model? Are we not going to use the model? The guy that built the model spent, oh man, I think like 6 months building this. And then my team is a validation team. So we came in and said, it's a fail. You can't use the model. It's terrible. It doesn't work for these reasons. And you end up in these really tense situations where people are really upset because they've spent 6 months of their time basically building something that can't be used now. And so learning those qualitative skills of like how to de-escalate situations, how to communicate better is also a big, big problem because often the business don't have a stats background or they don't have a math background. And so when you throw something out and say, oh, there's zero correlation in the model here, we're missing a component, you can't do this, they don't understand. And so then they like, well, that's close enough, let's just use it anyways. And so being able to communicate even on a dollar level of, hey, losses are going to be, much more severe in practice because the model is going to be under predicting, for example. Having those qualitative skills is very challenging and it's very hard to build. I think the only way to really develop them though is to have good mentors around you. So I've had really good management above me throughout who's kind of trained me and said, hey, you were a little too harsh in that meeting on somebody, or, maybe you could have went about this a different way. Maybe you could have talked to them privately instead of bringing it up in a big team meeting. So it definitely, the qualitative skills are very, very important. And I think it's really hard to kind of develop those alongside your quant skills.
Definitely. And also related to that point, you mentioned in your podcast that quants are going to be the first people that see the indicators of like a financial crisis. And I think like this was a good example too. Can you kind of expand on that point?
Yeah. So I'll give you guys a good example here. Oh man. So quants are typically, we're in the data, right? We're not in the daily flux of like looking at deal flow or looking at profitability metrics. And often the business sides, they're so tied to the profitability metrics, all they care about is making money and all they care about is making sure it's going higher and higher. On the quant side now, there have been some quants that are griping and complaining like we're not in a very good situation economically. And I think part of it is the quants realize that we have data, we see the data. I know it's not operating as expected, but often we also understand there's some other complexity we don't fully understand. Like I don't really know how it's going to unfold. I don't really know how it's going to crash, but I know that when it does crash, it's going to impact all of the models we have. And a good example of this in real world is we had a model that was predicting some asset values. And the business was like, this model is great. It's amazing. It works excellent. And so I go, okay, great. What's going on here? And they're really excited because the model's predicting, say, a value of 100. But what's actually happening is we're getting like 120. So now we're making a 20% increase on margin above and beyond what the actual asset was actually performing at. So everybody's really excited and they're super happy that we're making good profits. The problem is you look at this from a stats data perspective, right? The model is terrible. The model is under predicting all of these values and the market for some reason is performing better than the model. So trying to explain and bring people back to reality of maybe we need a better model here because that model is going to give us some sort of idea of what's going to crash this. So we're making record profits, but what's going to prevent those record profits or what's driving those record profits? So maybe, for example, like the pandemic is driving these profits and then figuring out when is the pandemic going to end? Or if it does end, what is that going to do to our model? And what is that going to do to our profitability? And so often I think the quants are kind of the first like leading warning sign of like, they're getting nervous because they realize their models aren't performing as well. They also realize when they go to develop new models, there's something, the data has shifted, right? The pandemic, for example, has caused a very, very large shift in supply chain issues. Prices of some things, for example, like used cars are through the roof because we can't get chips now. GPUs, other computer components are really expensive. So I think in general, quants are probably the best indicator, but often we're not listened to because we're just spouting data things, right? Like I'm talking about like, I don't know, like the model's under predicting or the residuals are no longer normal. And while this seems very stats wise, again, it's coming back to that communication. How do I communicate that to the business and explain to them like we need to be kind of cautious and weary of things that are coming up?
I guess that's where those kind of qualitative skills come in, right? Trying to be like the translator between the data and what's actually happening.
Exactly. I remember, just as a quick story, I remember we had a model. I worked underneath this guy on this model, and they had this finding, which is basically like they tell the business, hey, the model has an issue with it. And it was this really small statistical issue, and everybody just like said, oh, it's no big deal. But luckily somebody asked, what is the dollar impact by not fixing this? And I don't know why, but the guy I was working under had run the dollar calculation, and it was a difference of $100 million. So as soon as we said that, then everybody was like, all of a sudden, like, let's fix that, right? We need to save $100 million. And I think that's the communication piece. Often quants get so buried down into the details of like, it violates this assumption. And sometimes it's even impossible to back out the dollar impacts. So that's even more challenging. But if you can, it's very helpful to explain to the businesses like, guys, this is going to cost you $100 million. And then they're like, oh, let's do something about it.
Yeah, I think we don't want to save, 6 figures or 9 figures or something like that. That would definitely seem important. Based on what you were saying, Sas, and some of the snippets of code, I saw the semicolons at the end. I would assume that's MATLAB, right?
No, that's actually Sas. So Sas itself is an actual software type.
Oh, okay.
So I think we had that miscommunication at the beginning, but yeah.
Okay. You mentioned it in one of your episodes before too. We've had to do many homeworks for financial modeling and things like that. I think everyone uses Python, even though our professor wants us to use MATLAB for some reason. Do you have any thoughts on using like R, Python, MATLAB, Sas?
Yeah. So my advice to you guys is just pick one language and learn it as best as possible. The reason being, I think, is it's often harder to learn to program in itself than it is to switch languages. And even in modern times now, it's super frustrating because most banks were using Sas. Now 1 or 2 banks are using MATLAB. And now the majority are switching to Python and R. So now you're having to learn to program in Sas, Python, and R at a minimum. And now you might be having to do MATLAB at a different bank. So, I mean, it's half your day is going to be spent just learning languages. So my recommendation, especially as a student, is just learn the one really, really, really well. And then once you, like, for example, when I started my first job, I had never really programmed in Sas, but I'd programmed in R for most of my statistics classes. And the company understands. They know that, like, as a student, you don't get a choice on, I want to program in R, or I want to program in Python. So as long as you get really, really good at one language, it's usually not too bad to switch to another one.
Got it. And in terms of like efficiency or like I know in MATLAB, it's a lot easier to use like vectors, do like vector algebra and things like that. Each language does have like its pros and cons. Do you have like a recommendation of what we should focus on, or is Python, like you said, like the best to kind of like learn right now since that's on the up and up?
Yeah, so I'll give you an opinion on that. Functionality wise, I think R is the best language for statistics, and Python is definitely the best language for data science and machine learning. But as you're pointing out too, I think Python is starting to become just the more go-to language for most people. And so if you're going to pick one, I would probably pick Python just because that's what most people are using. That's where most banks are going. Again, I don't think you can actually go with a wrong decision. It's not as if like you learned R and then, you have to switch to Python. It's going to be the end of the world. But often if you can find the language that's just easiest to use for what you're working on, but I would lean towards Python, even though I'm not the biggest fan of it, just because a lot of the banks are kind of headed that direction.
Got it. Any questions? Okay. We got to figure out the microphones in here. I don't know.
Hi, Dimitri. Absolutely agree with what you just said about the qualitative skew and the quantitative skew. And I also remember in one of your YouTube video, you talked about, how some quant get into the trap that they focus too much on the math technical side, that they people follow them very hard to work with. And I think it's also very important to have someone in the team to interfacing between the quants and the business people. So so do you have any advice for us quant students? Because I think it's the issue here, like the communication issue. I think it's a real concern if someone going to like hardcore technical. So is there any way for us, quant students, to improve our business knowledge, our and communication skill, depend on what, like for example, what class we need to take in order to improve that, or what kind of activity to improve that.
Okay. So I'll touch on kind of the two parts here. The one part on communication and working with other people. The easiest way to do that is to do group projects. So it's not kind of a surprise to most people. Typically, when you have a group project, you have one or two people that do a lot of the work, and you have other people that kind of slack a little bit just because of scheduling or whatnot. But doing these sorts of group projects, I think, is beneficial in the fact that, one, you have to communicate what you're doing and how it fits in with the team. So classes that focus a lot on group projects, I know I hated group projects as a student. These will kind of be mirrorings of what you will do in the real world. Like you'll have to work on teams, and often you'll have different types of people to work with. So group projects are a big piece on that. For the business side, oh, that's challenging. If you can find the area that interests you the most inside of finance, I would recommend taking the business classes on that. So for example, if you want to end up in capital markets, take like the business versions of courses on like derivatives or on like equities and stocks. The reason for this is kind of twofold. One, you'll learn from their perspective on what they're taught and what they know. And then two, you'll actually learn a little bit more probably about the products and how they're used in practice. And sometimes even the way that the product is used will impact how you actually model kind of those product lines. So that's kind of my advice for that.
Appreciate it. Thank you.
Yeah.
Okay, cool. We don't want to keep you too long on here, but I have one or two questions based on what I've heard you say that I think would be useful for everyone to listen to. You mentioned in a lot of your episodes that you read academic papers and you stay up to date on things like that. That's like, we've been in school for almost 1.5 semesters now, and I haven't heard that from anyone yet, career management people or professors, anything like that. It seems like it's an important thing. Can you touch on that?
Yeah, so I'll clarify a little bit. I never got on my way just to like read papers to read papers. I mean, I would love to do it, but it's just, there's not a lot of time. But in the industry, you'll often end up with somebody who disagrees with you on some sort of quantitative piece here. And so one way to do this is to actually go and look at the, sorry guys. One way to do this is to actually look at the academic papers. So for example, augmented Dickey Fuller, right, the ADF test, I've had people say like, oh, I'm not reading it correctly. And when you end up in these scenarios, it's far better to find the actual original paper and read it and try to figure out what they were trying to convey than it is to go online to some sort of like Google form or to find it. Like textbooks are good, but now in the modern times, a lot of times textbooks aren't very accurate, depending who the publisher is. And so for me, I like to go back to the original paper here. Like one argument, for example, which I haven't really dug into too much, is there is the, what test is it called? There's the Shapiro-Wilk test for normality, but it hypothetically can only be calculated out accurately to so many observations. And once your data sets become too large, there's a discussion on whether the test is even meaningful anymore. And so, for example, I haven't had time to look into it, but the best way to do this is go back and find, for example, the original academic paper by Shapiro and Wilk and figure out what they said, why they said it, and how they set up their tests. And then you can kind of build off of that foundation, knowing that that's like, that should be the Bible. That should be like the fundamental foundation, the absolute truth. And then you can kind of build your own opinions on those.
Great. Any last advice for our young quants now?
That's a tough question. Man, best advice. Probably the best advice I have is do what interests you. So I think this is kind of we get kind of one story or one narrative of what a quant so-called is. And everybody usually wants to go towards one area because that seems like the most interesting. So typically investing and trading. But I think it's missing out on the point that like when I graduated, of course, I applied for like 2 Sigmas and Citadel and Jane Street and all these fancy funds, and I didn't get into any of them. And I went back and I was applying to like Goldman Sachs investment banking, to Lazard's investment banking due to my finance background. And I kept thinking like, I don't know what I really, really want to do. And so for me, I went back and looked and said, what was the most enjoyable course out of my entire, quant master's program here? And for me, it was a financial statistics course. And so I went back and rewrote my resume in a way that it was like the whole thing was just covering topics from that course. And then I ended up falling into risk management, which I think was an excellent fit. But for me, I would have never have even known the path existed. I wouldn't have gone the direction I did because I didn't really think about these careers that do or don't exist out there. Often there's things you just don't know. And so I think it's important to kind of look at your academic experience at least and figure out what do you really like, what do you really don't like, and then try to build a resume around that and kind of follow your passions, because it is far easier to put in, a 10, 12 hour a day when you enjoy the work versus like, I'm just doing it because it's the popular career or it makes the most money.
Got it. If there's no other questions, thank you, Dimitri, so much for your time here today. Great advice, great presentation. We learned a lot, and hopefully we can have you on, if not later this semester, I guess next year or next semester.
All right, perfect. Thank you.
And also, we'll cut the Zoom video or splice or whatever, but if you can email me your home address, Rutgers always likes to send a little something for guests. That would be great.
All right. Yeah, perfect. All right. Thank you guys.
Thank you, Dimitri. We'll see you.
Thank you.